So let's talk at the next one. RVPI, residual value to paid-in capital. So this one, another math formula for you. The residual value of the assets that are left in the fund divided by how much you put in. So the way to think of that, staying with our $100 thing, if we got 100 investors, we've got $100 in, and the assets that are still in the fund that still exist, because once again, it's a living, breathing fund. The assets, if they're worth $120 at that point, the RVPI would be 1.20 or 120%, because it's worth more than what we put in. Okay. A place where you usually see RVPI being very important, not necessarily in, and we'll talk about this on the next slide. RVPI, in my opinion, is not a very important number at Wasabi Ventures Stallions. Why, TK? I mean, it seems like it would make perfect sense. You know, how much are the assets still worth? The problem is that this is a very private marketplace. There aren't public markets for these assets. It's not the stock market. There are not even millions of transactions happening even privately. These aren't like collectible coins or something. You know, there is no super living, breathing market here. So the other thing is, there are private transactions happening all the time that value the assets, but for legal reasons and for strategic reasons, we do not do what's known mark to market. We'll talk about that in some slides coming up. We're not, as the type of fund that we are, because it's all private, we do not have to change the value of the assets as the fund is going on. Only if we sell an asset, then obviously then there's an exit value of that asset, and then that would change the value of the fund. So we leave an asset valued at exactly what we paid for it coming in, unless there has been a liquidity event. Okay, so if we sold it, then whatever it comes out of that, and so that might change the number. So that mark to market, we do that to, another key reason is we do that to defend, to protect our investors. If you mark to market, and let's say you have an asset that you say, oh, I think it was worth 20,000 and now it's worth 50,000, that becomes a taxable event to your investors, even though it's all on paper. If you don't have to do mark to market, you really shouldn't do mark to market. So that's why RVPI for Stallions is not the most important thing. But how are we doing? So Fund 1, we've actually sold some of the assets already. Some were not going to be performers. Some actually performed very well, and we made a little money, and we took a little money off the table. That was part of the returns that you saw. So what you see in Fund 1, 2, and 3 here for RVPI is what's left of what we originally invested in, if that makes sense, right? Because once again, we're not mark to market. So for example, we had what was a Jimmy Creed breeding right that was in Fund 1. We sold that. We sold it for a slight profit, actually, from what we paid for it. But then that came out of the RVPI, right? That was an exit. Okay. So that's RVPI.